So we're going to look at these, and we've got some great positions up here with our panelists of both VCs and CVCs and folks who have actually crossed over. So I'll start by asking you please to introduce yourselves.
Hi, my name is Ruth Foxe Blader. I am a partner at Anthemis. We are not a CVC. However, we are backed by many financial institutions. We are a leading global fintech and insurtech investment firm we've been around for about 10 years, and we have about 100 portfolio companies now.
Hi, I'm JD. I'm a partner at Iris Capital. Iris Capital is a pan-European venture fund, been around for more than 30 years. We manage around 800 million, which we invest from seed to very late stages and growth throughout Europe, but also in the US, in Israel, and the Middle East. We've been in companies like Kareem in the Middle East, Talend or Kiriba in the fintech space in the US and in France. Recently in the insurtech with Shift Technology, GetSafe. We're quite active in the fintech space. Typically, Shift Technology, we're a seed investor. GetSafe as an insurer for mobile and Gen Z. We're a seed investor also. We're in clear to pay in the payment space, but we're also generalists, so we're in robotics, we're in software, and so on. Our specificity also is we're an independent venture fund. We manage money that comes from family offices, funds of funds, but also corporates with whom we have strong partnerships. We have had a lot of exits in our history. We've collaborated with a lot of corporates. Many of them have actually asked for a closer relationship, so they invest in our funds, and we get to exchange with them on the next trends in tech, and sometimes to recommend them great companies to partner with or to buy.
Hi, my name is Oskar Miel. I'm the managing partner at Rakatan Capital. I guess that makes me the only CVC on this panel. So we only have one LP. For those of you who don't know, Rakuten is an e-commerce conglomerate operating out of Japan and internationally. And I manage our investments. It's a 4 billion portfolio that includes fintech, which is why I'm here, because with my colleague Mike here, we run the fintech fund, but also our ride-sharing effort, digital assets, insurtech, health tech. Some notable recent exits was the IPO of the IPOs of Lyft and Pinterest, as well as actually the sale of Kareem to Uber. We specialize in the growth stage, although we do some earlier stage investments or some Series A, and not everything's done fairly globally. And we normally are a fairly active investor in as far as we take board seats or an observer seat as a minimum. Thanks.
Okay. And I'd like to get a sense of the audience as well. So if you're an entrepreneur, please raise your hand. Okay. If you're a financial investor, pure VC. Are you any CVCs? Okay, awesome. So again, I've got a bunch of questions, but like with my previous panels, if you have them, please, even from the beginning, put up your hand, and we'd love to have you involved in the conversation. So I want to start off with highlighting the difference between, if there is any pattern, between a traditional financial and VC and a CVC. So, tell me about your thesis. Tell me why you exist. Let's start with you, Oskar.
Sure. Well, I think it's a fairly mixed bag, to be very honest with you, right? And put it this way, when you read some of the research, the theory is that CVC doesn't actually work, because normally you're at the mercy of, I guess, the corporate, and if you're trying to pursue, I guess, synergy or some specific corporate agenda, you're effectively biasing your investment process. So I think the reason why we've been successful, and we have an IRR of 28% actually, which is about like 60% above the industry average. And the reason why we've done well is because we traditionally operated with great independence, right? So we operate a very small team of 6 to 7 individuals managing 4 billion in assets, operating globally. And well, when we put this together, the theory was, sure, we can do things that will benefit the organization, some of the investments can be strategic, but in reality, we get compensated and rated based on the financial returns that we generate, and that's how it works. And any potential, I guess, synergy or commercial alliance that you might have between the startup and the corporation, it's completely at arm's length, and it's kind of like the cherry on the cake. And of course, you know, the name helps in terms of flow and so forth, but you have to split both. If you mix them, by the time you find the synergies, the deal normally would have traveled away.
Okay. Ruth, would you mind highlighting your previous experience and then talk about what you've experienced as the difference?
Sure. Yeah. No. So I started my investing career at Allianz, where I was looking after fintech investing in Munich. And I think that when Oskar said it's a mixed bag, I agree. I think that there's a lot of diversity among CVC players. When you think about why companies do corporate venture capital, I mean, essentially, you know, Anthemis is a very mission-driven organization. Our thesis is that change in financial services is an evolution, not a revolution. And so it follows that financial institutions want to come into contact with emerging technology. I also believe that the enormous changes which will occur in financial services will come from outside, largely from outside of existing financial institution incumbents. You know, there'll be some exceptions. So I think it's sensible to want to come into contact with emerging tech, and at Allianz, that was the purpose of my job. The question is, you know, and I think that we function very similarly to Iris Capital in that we have a large LP syndicate which comes from industry incumbents. And we attempt to not only bring those guys into contact with emerging tech, but also to, through our portfolio success team, to bring our startups into contact with those LP partners and the ecosystem to service our portfolio companies, or to partner, or to provide risk capital, or, you know, any of the numerous ways that financial institutions and startups can collaborate. I think the tricky thing, and the reason that we're having this panel, right? Like, we're having this conversation for a reason, because there is a tricky thing. So the tricky thing is that in all markets, volatility and unexpected behavior, or behavior which could be considered a little irrational, can be very dangerous. And I guess an example would be a startup taking you know, direct investment from a corporate venture capital arm, which then doesn't follow on in the next round. And, you know, as we all know, as the people who are raising money or who are investors know, that there's a signaling problem there. And it might not come from poor performance of the startup. It might come from, you know, the inability of the startup to deliver some value, or have a collaboration, or a change of kind of, you know, staffing, or a desire to pull back on venture capital. But nonetheless, that signaling is out there. So I think I think that there are some really interesting, excellent corporate venture capital investors. And I think that it's interesting to talk about the trickiness of when and how companies take money from CVC.
So thank you for the nicely brought polemic topic. And Oskar already hit someone, so I'm going to be very careful here, because he's still got one fist left. Yeah. Now, truth is this. Let's take the issue some other way around. We celebrate fundraisings. We talk about how great companies are and how much money they can raise and from who they can raise it. There's one thing we forget these days. It's an exit game. We're putting all that money at work with companies so that they can go big and exit. Public markets, private markets, M&A, I don't care. At some point, our job as financial investors is to bring the money back to our LPs, and the job of innovation is to consolidate within a larger ground. So the name of the game we'll pursue is exit. This is the one thing missing in the ecosystem over the past few years. So we're talking about investors, but the truth is, seen from the outside, we're pretty much all the same. We got money, we love you, we want to be part of your game, we want to put money in and be part of the board. Truth is, the nature of the money we put in is different. Nature of a corporate, build products, sell them, make margins, pay salaries to employees, repeat. My game, take money from LPs, put it at work with companies that grow big, then sell it and bring a lot of money back to my LPs. The nature of that game is different because my job is to find companies that are going to scale and be worth 1 billion euros so that I can sell it to Rakuten, so that they like it so much they're going to buy it at 1 billion, 2 billion, so that everybody's happy. The job of a corporate is to try to integrate innovation faster and not pay 1 billion for it. Used to be called R&D in the 2000s, in the 90s. Now it's called the startup game. This is what we do. We innovate, we bring companies on board, and then we try to make innovation worthwhile. The difference between our game, whether we like it or not, we want to tell it or not, I got to make companies look big. Because the nature of my firm is to generate profit by having big companies generate tremendous profit. The nature of a corporate is to generate more margins. So they need to find innovation early so that they can identify it, they can integrate it as fast as they can. If they can't, yes, they're very happy to make a profit out of it the same way we do. But you take a very large corporate, you look at their P&L, their value and the value they distribute to their shareholder needs to come from the P&L and the business they generate, not from financial investments. That's the nature of the difference. So if we apply, and by the way, there's a great author about this. This is George Lerner. He's the best teacher you can find at Harvard Business School about venture funds. So that's what I'll explain to you. So if we come back to the nature, actually we're quite collaborative because we want people from the CVC to like our company. Sometimes we want them to be early in the game so that they can be inside and see that this company grows so big they need to acquire it fast. Sometimes you'll make a better profit having 50% of a company that sells 100 million rather than having 5% or 2% of a company that sells 2 billion. This is how CVC and VC reconcile. Not all companies are meant to be worth 2 billion because there's not many people right now able to buy companies 2 billion. Name them, besides Salesforce or the others, I don't know that many.
Visa?
Yeah, oh yeah, that one. And you know, there are a couple of them, Apple, Google, and so on.
Yeah.
But so the point is, it's not about how different and feisty we need to get. There are companies that are meant to go public. And on these companies, my job is to make them very big. And sometimes the CVC will tag along saying, I won't be able to acquire them, but I can make good money. But they're not going to be a lead investor because this is a financial play. Sometimes you look at synergies, you want to be in early so that rather than letting the company go for 2 billion, you're going to be able to preempt. By the way, CVC, look at preemptive rights. Sometimes they're there, sometimes they're not. This is, I think, the nature of the difference. This is why we collaborate so well. This is why sometimes corporates invest in my funds because they want to know about innovation. They want to look at companies that scale. They want to be able to say they were in for financial returns, but they were not touching the company. And sometimes they'll build venture arms. Orange has its own venture arm, although they're an investor in our fund, so that they can do CVC while I do VC. Publicis is the same, Bridgestone the same, Valeum the same. So I think it's a complementary game. I think that's why we tag along quite well. That's why depending on the companies, sometimes we'll fight against each other, but I don't think it's natural. Or we'll actually look at ways to collaborate for the long term of the company.
Yeah, please.
So I agree, although I do have a bit of a different view, right? I think it kind of depends very much on the entity, right? So again, if you do have that independence, you have to effectively operate as any independent type of firm. What you're alluding to, I guess, with a lot of the corporate LPs that funds are having right now, I think it's the latest trend, which also actually shows how some of these corporations, they cannot really pull it off on their own because they don't have the expertise, right? So they'd rather like pull the capital into a fund, right? And then arguably benefit from that innovation or whatever news as a GP, I guess you're passing on. What's not very clear to me is effectively to what extent they truly benefit, right, from that innovation. I think, like, some of it is just like, paying in a pure lip service to it. On the flip side, and I'm also like a purist when it comes to operating profits, etc., right? But I mean, even our unit, trust me, is fairly substantial in terms of the profits that we bring to the corporation. Or if you look at other Chinese giants, Alibaba, Tencent, the line that comes from investments is huge right now. I mean, Tencent is effectively more of an investment house, or if you want to stretch it even further, SoftBank wouldn't be where it is today had they not invested that money in Alibaba, which kind of like led to a lot of the Vision Fund and so on and so forth. Even though they did have their own SoftBank ventures arm. So I think it's all relative, right? And it's very difficult to actually pinpoint which model is a winner or a loser, because it very much varies by corporation.
How do you think an entrepreneur should decide who's the right mix of investors at a given stage, given all these choices? What are the questions they should be asking themselves?
I mean, I think that's the fundamental question that we're talking about. And that's always whether you're talking about taking money from CVCs or who's leading your round, or you have 2 term sheets, which one do you take? Which, by the way, all are luxury problems. And I think one of the things that where this topic becomes more nuanced is like there's a big difference between when things are going well and when things are going less well. And who's around the table. What I see in financial services, and I think that Rob mentioned it on the previous panel, is that it's extremely difficult to not have an incumbent financial institution involved in your financial services startup somewhere in the capital stack, or involved with some part of the business. Whether or not it is high risk to then also include that collaboration partner, that commercial partner on your cap table is a super important question, and a question which, as we're talking about valuations, has the potential to limit the value of the company. Typically, I guess, if I were giving advice to entrepreneurs, I would say probably better to involve more than one entity than one single entity if that's the road that you're going down. But as Oskar said, there's just so much diversity of the quality of investors. I tend to I think that the kind of Tencent and Alibaba, interesting examples, and certainly providing substantial returns to the balance sheet, I think that that's very rare. And so we've seen a proliferation of CVCs in the past 5 years. Massive number of funds and also amount of capital, and I don't think that every single organization that launches a CVC unit is necessarily attracting the most competent venture capital investors. So I think it's very individualistic. But I think that the other thing that is worth considering is how are the investors themselves motivated? Do they have carry? Is there a sort of expectation that folks will kind of change jobs every 3 years in this type of organization, or every 4 years? What's the time horizon that you need this person deeply involved in your business for? So I think that the questions become very nuanced, and there is something really interesting about having your own CVC, investing in funds in order to get access to the ecosystem, doing your own internal R&D. I don't think that these approaches are wrong. I just think that organizations need to cultivate more rather than less.
I love this panel. Surf along the lines. Here's the thing. Again, this is a great time for entrepreneurship. There's plenty of money around. The question is, what kind of company do you want to build, and what kind of money? And the money you're going to choose is not going to condition the company you're going to build. The way you're going to build the company is going to condition the kind of partners you're going to choose. Truth is, in some cases, you will want to grow big, you will want to grow fast in a sector that the fund has already invested in. And then, hey, you've got the right partner. If they like you, you should take them. Some other way around, you're just, first foray into a new area, into a new space. This is pretty new. Here again, funds that are specialized in newness, willing to take risks, because that's the thing. Philippe Colombel said it right. We're paid to take risks. Corporates are willing to invest money, sometimes to take risks, and I think Oskar has illustrated well the way some corporates are completely behaving like funds. Some others will try to tag along, but the responsibility of taking too many risks on the P&L, again, will be a limitator. And here, this is not me advocating in favor or against. This will be part of your due diligence to know whose specificity it is to accompany you well. In some cases, the expertise, the capacity to reinvest, the intuitive personnel of the investor because you have a right fit, you're going to be calling that person on Saturday night because something went down. Some of the cases, just a name, either the name of the fund or Axel and Ballerton. Personally, even me would like to have Axel and Ballerton in my holding table. But on the other hand, sometimes having the name of Rakuten makes a lot of sense because you're in e-commerce and hey, you're backed by motherfucking Rakuten. This is big, this is huge, this is serious. So for me, as a front for entrepreneurs, we're pretty much the same. We're money to which you're going to give flavor. For some entrepreneurs I know who are actually quite bright, they tell me money is no flavor. This is very insulting for me and the time I spend trying to generate value. But the truth is, for some of them entrepreneurs, I respond to the phone, I've made introduction, I've brought in some people, and when times were rough, I put money back in. This is pretty much, for me, the criteria of you investing. And then the story you're going to tell yourself, because in the end, the story you're going to build is going to be the story of your company. There's no better, there's no worse. There's just what you need. Again, I think the important point to distinguishing some of us and some of the others is the hard part about being like a parent, because you're parent to your company. I remember a long time ago, friends of mine, they wanted me to talk to their child because he was not good at math, and they really wanted him to go to the top school of math. And so talked with a guy, great guy, super smart, not into math. Go try to explain to parents that he's just not great into math, but he's going to do something else and it's going to be great. You have a responsibility as entrepreneurs to look at your product, to dream big, to have a vision, to go somewhere, but be pragmatic as to how you go there. Sometimes you're on a tough market, you get the best company, but guess what? There's no room. Sometimes you have great potential on something that hasn't been done before. The way you relate to your potential will be sometimes to try billion-dollar companies because this is what we're all hype about and this is what the press talks about. Sometimes it's finding industrial partners who will lead you around the right way to get the best exit, the best sponsorship, and sometimes, yeah, your investor might be a potential acquirer. Again, remember, having 50% of a company you sell 100 million or 50 million, sometimes is better than having 1 to 10% of a company you sell 2 billion. Yours judgment to take, and the people around the table will give different nature to your adventure. That's pretty much it for me.
Yeah, so I agree with all the comments. I would add two points. I think one, in this space specifically, sector knowledge is very, very important, right? So, you know, whether it's a corporate VC or, I guess, an independent one, when you're a fintech startup, you want to go with the people that actually have some understanding of what you're doing, because it's not always the case, right? And what you don't want to be doing is effectively getting money from someone whom you have to educate, especially at board level, because they can, you know, some person can swing decisions at that board, and then the company can go in the wrong direction, and that's actually done because of that lack of knowledge. And we've seen this in this space. I mean, particularly, you know, like lending, you know, and the circular accounting, etc., or payments, which is very, very specific, and how some of these funds have actually no idea about what they are doing. And yet, yes, they can help the companies, right? But it's not just about the money; it's about getting smart money. And the second point is to what you guys also said, particularly about continuity, right? It's very important to know that the people that are gonna be going on this journey with you are gonna continue to be around, right? It's like a marriage, right? Or, well, I mean, I would compare our jobs to, I guess, being a film or theatrical producer, where we are the producers and you're working with the film directors, right? And there's always a strain with, I mean, sometimes a relationship goes well, or, you know, they love you up until when they have your money, and then they can go crazy on you. I mean, there's a lot of psychopaths out there, right? So it's very important to do that hand-holding, right? But it's kind of like a two-way street, right? So relationships matter, and they matter especially in venture.
Very good. Any questions yet from y'all? Not yet. Okay. So how do you think about how these, you're right, we've talked a little bit about how the structures of often CVCs are different, but I'm curious about the value adds, right? Because what'd you say, money's easy, right? The question is, what else, right, is someone bringing to the table? And continuity was a key one that I heard, and I heard things about building teams and things like that. But I want to try and dig into that more. Are there key differences between the value adds that an entrepreneur should expect from one versus another, right? A VC versus a CVC, and how do you tell?
If I can, yeah, sure. If I can take that one, again, I think it comes down to the individual. I mean, as a board member, what do? Yes, you have to sanction options, packages, issue opinions about which way the organization is going, but what you do want to have is somebody who actually gets strategy, has a vision, and that vision is aligned with that of the CEO. I think the worst that can happen to an entrepreneur is that a firm makes an investment and they think they're going to get the senior partner who kind of did the investment or negotiated, and next thing you know, it's like the principal or the junior guy that shows up at the board, and these guys unfortunately don't have that type of expertise. And beyond that, I guess, is the commercial relationship, but again, that's at arm's length, right? Because even if you are a CVC, you cannot force a business unit to do business with with an affiliate or with an investment of yours.
So on this one, I'm going to get back to Ruth's comment earlier on, which I agreed very much with, which is, that's where I disagree a little bit with you, Oskar, because yeah, we're selling the Intuitu persona game, and it's true, you're going to meet people around the table when you're going to meet us first, and you're going to meet people who are going to get enthusiastic about your company and are going to fight for you. But the truth is, there's a durability, as Mike mentioned, about the fact that here we're going to stay. I mean, as Oskar said, this is a marriage for us. We invest after 10 hours with you, 10 million, 5 million, and then we're stuck until we sell our shares. So actually a marriage, you have much more time to think about it normally these days. Anyway, anyway, children of our time. But so moving back to the point is a firm is a history. It's a history of investments, of expertise, of partnerships, of exits, of failures. This is what you onboard with us, and this is remnant, because suppose I leave, and although it's hard for us to leave, we have carried, we have partner shares that we need to sell, so honestly, the financial carry is not about us going completely rich. It's rather rare in Europe for the moment, working on it, and thank you for that. But actually, the part where we invest a lot of money in the funds to stay makes us stick. But also, when Iris, Anthemis, Balderton, whoever invests, you've got the history of partners who have been around for 30 years, have done exits. We were discussing that the other night with Mike. VC is biz dev. The best profile of VC guys you're going to find on the market are either former biz dev guys or guys who've been VCs all their life, but actually they're biz dev. We raise money with people, we bring money to others, we know people, we make things happen. That's what we do. It's not exactly a skill. It's hard to explain to children, but that's what we do. So moving back to the triggers of VC, it's the durability, it's the reach and network, because we're a network game. This is the kind of emperor we're going to give to your project. We're going to do it because we're at boards, we exchange, and this is what you're going to evaluate through due diligence with other entrepreneurs we've backed or who have just fired us because sometimes we're just not convincing enough. This is, I think, what you look at, and this is what a VC is supposed to bring in at some point besides money.
Yeah, and I think maybe the kind of connective tissue between what I was saying before and what you were just saying is that, who is that investor, and are they going to be there long term in the CVC context? I guess one thing that we haven't talked about is, if you're taking money from someone because you think that they're going to help you do business, you think that you're going to have a big commercial partnership which is going to dramatically impact your business. I guess the question that I have for entrepreneurs is, well, should you take the money before you guys do business together or after? Like, we often see lots of corporate venture capital firms very, very interested in our companies, and what the entrepreneurs will say is, well, then we could distribute in X geography, or then we could have risk capital, and it's like, okay, well, just sign that deal, and then we can talk about a path to ownership. Like, which comes first? So I think that there are sort of some fundamental questions that as investors we can kind of help entrepreneurs ask in order to make the kind of promise of corporate involvement make sense, rather than sort of have, I think, the worst case scenario, which is someone's very excited about the business, and typically that's an individual, a very enthusiastic, great individual, but who can't necessarily bring their entire organization along, and they could be very actually useful as an investor and very helpful. So I'm not denigrating anyone's potential to positively impact a business, but the promise of that bigger commercial partnership doesn't get realized. And then it's always like a little bit of a weird story where it's like, oh, well, why are these guys on your cap table? Are you doing anything with them? Oh, you're not? Okay. What happened with that? VCs see so many deals. Anything weird, we're kind of like, wait, that doesn't make sense, move on. So I think that what entrepreneurs can do is make a great story that hangs together. And I would encourage entrepreneurs that I'm involved with to do things that kind of make a great story that hang together.
Any further thoughts on that? Okay, so one of the other questions that Julien and I discussed the other night was the difference in VCs and CVCs in different regions, right? And I'm wondering if you notice anything between European, U.S. or Asian, and in particular, right, given the recent investments here in the French market, Chinese CVCs or VCs. Have you noticed anything?
I'll be short on this because it relates to your point earlier on about Tencent making huge bets and some P&Ls of some corporates changing nature and becoming financial investors. I think we're living in an era where we're learning again. Some people like to call it the end of capitalism. I don't know what it is, but what I know is the way money is valued these days is different. So I wouldn't be surprised that some players, depending on the region and the amount of cash available, change nature. Because SoftBank is a good example, although right now being challenged. People will change. What we see in Europe right now, lack of exits, strong involvement of VCs, either as CVCs or investing in funds. Some of them doing it massively in funds, not getting a lot of value, as I mentioned. Some others with us investing large amounts for just a few corporate VCs getting more value because they can look at deal flow, collaborate. But so in the end, in Europe, what we see for the moment is corporates trying to learn about the tech space, directly or indirectly, sometimes boldly, and sometimes they retrieve afterwards, sometimes very cautiously. And for us, the goal of that game is for them to do more exits, to acquire you more so that we generate more liquidity to the market so that the success track is on. In the US, we have a lot of exchanges. We're active there, or in Israel, where we're quite active. What we see also is corporates, the frontier remains quite visible. Corporates taking bets to learn or to partner or to invest in tech that they think is relevant versus corporates going massively. And that's why you see so many exits in the US right now. I mean, corporates buy. I wouldn't speak for other regions or for other views, so I'll share them out.
Okay, I think it's very difficult to compare, very frankly, and that's partly because of China. So especially in fintech, with the walled garden approach that they have, China has become effectively the most developed fintech market in the world, with amazing convergence with e-commerce and other platforms. And right now, with the advent of 5G, especially, I mean, like Huawei are even proving right now that they can make phones without the US chips, which appear to be very, very difficult even a few months back. So, but you can't really quite export that model because you don't have any other market as such. I mean, I guess like, US in terms of population, albeit smaller, but with very, very different dynamics. And what those guys are doing right now is actually trying to export the model to neighboring countries throughout East Asia. And I would say that they will get there, and they will do it probably a lot more successfully than the West. And the additional trend is that of the super apps, where you effectively see sectors such as transportation or ride sharing getting into financial services, and then from there getting into everything. Two notable examples are Grab and Gojek. It's going to take a lot of capital, many years, but eventually they're going to kill it.
Okay. Any final thoughts, Ruth? No, you're done? Okay. Will you be? Okay, fair enough. So we're out of time. Will you be around if anyone has questions? Yeah. All right, there we go. So thank you very much.
Thank you.
My pleasure. Thank you all. And